The balance sheets of Singapore households are generally in good shape. That's according to the Monetary Authority of Singapore. In an exclusive interview with the Channel News Asia today, the MES says the latest measures aim to prevent individuals with credit card problems get further into debt. Meanwhile, analysts say the various debt-reducing moves by the central bank is a prudent move to curb borrowings in a low-interest rate environment. Yvonne Chan reports.
A slew of measures have been implemented to curb the burgeoning household debt in Singapore. In just under a year, restrictions on the loan tenure for residential properties was introduced in October 2012. Then came financing restrictions on motor vehicle loans in February 2013. Property loans got hit again when the total debt servicing framework was issued in June this year. And now the latest, new rules to curb credit card and unsecured debt.
MES has taken a series of measures to restrain borrowings for various types of household debt, including car loans and mortgages. And the objective really is to avoid households getting into too much debt and borrowing beyond their means.
Compared to other economies' debt in the region, analysts say Singapore fits somewhere in the middle.
We've got Thailand, Malaysia who are well ahead. In 80% for Thailand's case. Korea is, I think, leading the pack, targeting 90%. And Singapore is, depending on how you take the measure, either in the 60+% or going to hit 75% of GDP. All of this, I think we want to keep it in context, which is net household assets are also very high in Singapore.
The MES says Singapore's household debt situation is not that dire, and analysts say the latest measures will help to rein in rollover as well as credit card debts, so that when interest rates start to rise and financing burdens for homes and cars start to rise as well, these households will be in better shape to pay back those loans. As for banks in Singapore, experts say these measures will have little impact.
Of these types of businesses, the credit card and unsecured are reasonably small for those banks, so we wouldn't expect a big impact. There could be a very small impact, say, on interest income. The other thing we've noted as well is that the impact of these similar rules in other countries has not had a big impact on banks in those markets.
These markets include the US, Australia and the UK, where there's been a big push towards responsible lending.
Sale of new private homes are